Assalamu alaikum wa rahmatullah. Today, inshallah, we will continue to talk about the financial statement. So now we have to talk about the second financial statement, which is the income statement. So what does mean the income statement? So as definition, the income statement is also known as profit and loss statement or the statement of revenue and expenses. It's a financial report which is provide expenses and revenues, losses and profits during just 1 year. It means less than 1 year. This statement gives an account of how the revenue released by the company gets transformed into net income. So the income statement, or the format of the income statement could be provided as follow. So these all the elements of the income statement. We start with the sales revenue or turnover, and we finish with the total net income. So now we move to details of these elements. So we start with the sales revenue. This concept or this sales revenue are the money generated from normal business operations, sales of goods or services or products, calculated as the average sales price per unit times the number of units sold. Change in inventories of finished goods and work in progress. This account refers to the variation between the closing inventories and the opening inventories. If the variation is negative, it will be deducted from the sales revenue, the income statement of course, because it is part of the cost of the goods. Another account is the own work capitalized. The cost, this element, it means the cost of fixed assets that have been produced by the company itself. We have operation grants or subsidies. It is defined as funds given to the company by the government to support its activities. Purchases consumed. It refers to the cost of raw materials and other items that are involved within the production process of goods that are sold. The formula of this purchases consumed is equal to starting inventory plus purchases minus ending inventory. It means the starting inventory in the starting of the year plus the input minus the ending inventory. Another account is the financial revenues and the financial expenses. So the financial revenues are revenues generated by the invested in the short-term investment and the marketable securities. It means the financial activities such as equity interest, sales of marketable securities, interest from bank deposit. However, the financial expenses are costs incurred from borrowing from lenders or creditors. They are expenses outside the company core business, like interest, commission, losses from sales of marketable securities, and so on. We have also the exceptional expenses and the revenues. This exceptional item is unusual business cost or source of revenue that is reported separately from ordinary expenses and revenues and have a material impact on a company's financial result. For example, here, capital transaction, it means when the company increases its capital. We have also damage from natural disasters such as earthquakes. We have also the income tax expense. Is the amount of money owed by the company to the taxing authority. This income tax expense is calculated by multiplying taxable income by the effective tax rate. So this tax rate depends on the type of the company. You can find 90% for the manufacturing and production company, 23% for the public works and service activity, and 26% for the commercial and other type of companies. Now, we move to understand or to determine what are the different indicators that measure the performance of the company throughout the income statement. We start with the commercial margin. This indicator is just from the company who practice the commercial activities. It refers to the difference between the selling price of a product and its cost of price, representing this profit margin made on sales in commercial activities. The formula of this indicators is as follows. The commercial margin is equal to sales revenue minus the cost of goods sold. However, the cost of goods sold is equal to starting inventory plus purchases, meaning the input, minus the ending inventory. We have another indicator here, which is the production margin. This is consacrated for the production company. These terms refer to the difference between the revenue generated from the sale of products and the direct costs associated with producing those products. It indicates the profitability of the production process. We can calculate this production margin as follows: sales of product minus cost of raw material consumed. The cost of raw material consumed, it means the output, is equal to starting inventory plus the input, means the purchase of raw materials, minus the ending inventory. We have also another indicators after knowing the commercial margin and production margin. Now we can calculate the sales revenue or the turnover. This sales revenue, it depends on the type of the company, if it's commercial or production. And in another case, we can find a company that practice production and commercial activities at the same time. So in general, the sales revenue is equal to sales of finished product plus sales of goods plus services. It means if the company, if we talk about the commercial company, in this case the sales revenue is equal to sales of goods and services. If we talk about production company here, it's equal to sales of finished products and services. And if it is mixed company, here in this case we can global all these elements. We have another indicator, is the value add. It means how much wealth has been created throughout the principal activities of the company. We can calculate it as below. Is equal to commercial margin plus production margin plus outward capital plus operation grant plus production inventory, or is equal to operating revenues minus operating expenses. After knowing the value add, now we move to another indicators that we can calculate throughout the income statement, which is the earnings before interest, tax, and amortization, EBITDA. EBITDA is an alternate measure of profitability to net income. It is used to assess a company profitability and financial performance. The formula of EBITDA is equal to value add minus salaries and other personal expenses plus tax and duties. We have also earnings before interest and tax, EBIT. It indicates the profitability of the company. EBIT is also referred to as operating profit. Operating earnings or profit before interest and taxes is equal to EBITDA minus amortization and depreciation plus reversal of provisions minus other operating expenses plus other operating incomes. We have also the financial result. The financial result, or the financial income, it is the difference between the financial revenues and the financial expenses. It could be positive or negative. This account is just for the company who practice the financial activities. We have the income before taxes or for ordinary activities. Earnings before tax or pre-tax income is the last subtotal found in the income statement before the net income line item. We can calculate these indicators throughout the EBIT plus the financial income or the financial results. The last indicator here is the net income for the ordinary activities, is the amount of accounting profit a company has left over after paying off all its expenses. It is found by taking sales revenue and subtracting all the expenses related to the ordinary activities of the company. Means here the net income is equal to income before tax for ordinary activities minus income tax expenses. Now we move to another indicators. Here we talk about the activity ratios. So throughout the income statement, the company could calculate several ratios. We start with the inventory turnover. It measures how efficiently a company is able to manage its inventory. The inventory turnover is equal to cost of goods sold divided by average inventory, and the average inventory is equal to starting inventory plus ending inventory divided by 2. We can convert this inventory turnover to inventory turnover time period, and is equal to 360 days divided by inventory turnover. It means here the inventory turnover by time, it means how many times the inventory stay within the company. Now we move to another activity ratios. Before that, we have to know what does mean the inventory turnover. It could be positive or negative. So a low inventory turnover ratio is a sign that inventory is moving too slowly. On the other hand, a company with a high inventory turnover ratio can be moving inventory at a rapid pace. However, if the inventory turnover is too high, it can lead to the shortages or the scarcity and lost sales. We have also the payable turnover. The payable turnover is it shows how many times a year a company pays its suppliers. It is calculated as below. Payable turnover is equal to total supplies purchase divided by suppliers or payable counts plus notes payable. Payable turnover times period means here we can convert this payable turnover into payable turnover time period. Is equal to 360 days divided by the payable turnover. We have also receivable turnover. It measures the number of times a company collects its receivable from its customers. Receivable turnover is equal to sales revenue divided by customers or accounts receivable plus note receivable. By the way, the receivable turnover times period is equal to 360 divided by receivable turnover. Now we move to another concept, is the self-financing capacity. The resources available to the company could be external and internal. foreign resources may come mainly from capital increases, investment grants, and loans. Internal resources are earned through the company activity. So the self-financing capacity is the potential liquidity generated by the entire activity during the exercise, which remains at the disposal of the company. The calculation of self-financing capacity is so important for a company because it provides a complete picture of the amount the company can pay to its shareholders in the form of dividends. Those it can invest in the growth, and those it can use to take out or to pay out the loan. There are two conditions to calculate the self-financing capacity. The first condition is to determine the cashable revenues. It means the real revenues, it refers to the revenue that results in a real cash inflow, meaning that funds really enter the company's treasury. For example, sales revenue, operating grants, and so on. Second condition is to determine the cashable expenses. It means the real expenses that lead to real cash outflow. It means that funds really go out from the company, like the purchase consumed, the salaries, taxes, and so on. So we have also, after knowing what does mean the self-financing capacity and knowing the condition, now we move to how can we calculate this self-financing capacity. So there are two main ways of calculating the self-financing capacity. The first is through the net income. This method, known as additive, is the fastest and most widely used. It is based on the net income of the company. So the self-financing capacity through the net income is equal to net income plus no cashable expenses minus no cashable revenue minus proceeds from disposal of assets plus net book value of assets disposal. By the way, the second way is through the EBITDA. It means earnings before interest, tax, and amortization. This method, known as subtractive, is based on the EBITDA plus other operating revenues minus other operating expenses plus financial income minus income tax expense plus exceptional income. The last indicators that can have throughout the income statement is the net self-financing. Is that part of the remaining self-financing capacity after the distribution or the payment of dividend. The formula here is equal to self-financing capacity minus payment dividends. So thank you for watching, and I hope that you understand the income statement. So next time, inshallah, we will talk about another financial statement, which is the cash flow statement. So see you, inshallah. Thank you very much.